Good day, fellow investors. Recession fears are mounting, but always keep in mind the recession is the best time to invest. So, just top stories: copper prices plunge to 20-month lows, and copper is usually called Dr. Copper because it usually signals a recession, it signals what's going on in the economy, it signals the market's expectancies, and you can see how copper from doing well is going into the dumpster now. And why is copper called Dr. Economy, Dr. Copper? Because it is used in the core sectors of the economy: building construction, electrical, transportation, cars. And if we look at car sales in the United States, for example, we can already see that those are pretty subdued for normal averages, which is again a signal that a recession might be around the corner. But also, not just that, economic outlets have started increasing those recession chances, maybe not in 2022, but definitely for 2023, as spending subdues because of the Fed's actions, of course. Suddenly fragile. So, a few months ago, nobody was even thinking about a recession. Stocks were extremely high, and now there is a 71% chance of a recession, which is really something. The reason, of course, rising rates make all asset classes go lower, thus destroy wealth. Also, when you make investments, it's a big difference to make an investment at 3% or at interest rates of 5-6%. If you need to borrow to have an investment case, you need to make now double the return to justify it, which again slows down investments. Then, when it comes to recessions, we have to discuss the Fed. And this is always something that my grandfather used to say: operation successful, patient dead. And the Fed is now really strong in its rhetoric to curb inflation, and we can see that tightening cycles usually end in recessions. And as Druckenmiller said recently in his interview, we cannot stop inflation above 5% without a recession. It has never happened. And we can see here the many times that the Fed goes into tightening and inevitably leads into a recession, because if not, you cannot stop the economy from overheating, and they are trying to balance that, but it cannot end in a soft landing when inflation is above 5%. So we have had recessions, of course: 2009 financial crisis, the terrible 1970s, the 69, 72, as we have already seen here, 20% interest rates, and terrible double recession of the early 1980s, 1974. There were some cases where it didn't go into recession, but also inflation wasn't that high. But let's now take a look at what the Fed has recently said, because I really want to differentiate between action and rhetorics. Always keep in mind what the Fed says moves the market. So the Fed is more thinking about what it will say and how will that impact the markets than about what it actually has to do, because they don't even know what they have to do. So that's a different story. But always think about the rhetoric and how they try to move things with rhetorics. That's very important. This is the summary from Bloomberg, but perfectly fits the federal minutes recently. So they are prepared, if necessary, to eventually raise interest rates to levels deemed particularly restrictive to the economy in order to crush red hot inflation. So they are now ready to do that. 6 months ago, they were saying, oh, it's just transitory. We can keep interest rates lower forever to push everything higher, blah, blah, blah. Now they are strong. So they're trying to send the message that they will do everything. Interest rates are still below 1. So that's what they say and what they really do. And then they say that we will increase 75 basis points, no problem there, next meeting, blah, blah, blah. So, okay, they will continue, but will they really go as far as they plan? That's always the question. Will they bring it to 4, 5, 6% if necessary? Keep in mind what they say and what the reality is pretty different. And now, of course, economic growth concerns, labor market is cooling, but they say that inflation is now the priority and they are trying to lower it with talk. That's now the reality, not with actions. First with talk. If they can lower it with talk, they would have done a great job. And they try to say they will do whatever it takes, willing to accept the price of a slowing economy in order to tame inflation, hoping that they will tame it with words and that there won't be a slowing economy. So that's something to always keep in mind what the Fed says and does. And then you have more comments now. Recession, the hot topic. How will it be long, painful? And that's not really something to predict, but also not to be surprised on. We have been partying for 40 years in Europe, in the United States, constantly lower interest rates, and what Ray Dalio has been warning us about the short and long term debt cycle. At some point, the long term debt cycle also has to come to an end. We don't know. Maybe it will last another 10, 20 years. Hopefully for us, maybe not. So, hopefully for the younger generations, it's better to crash now so that we start with a new cycle from lower highs than if it continues with more money printing and hyperinflation for the next 10 years. So, depending on where you are in your age, you have a different perspective on things. But it is difficult to predict what will drive, and it will likely be ups and downs. The markets have been going up for the last 4 days, so they are expecting the Fed to chicken out. So, yes, rhetoric, blah, blah, blah. Show me 4% interest rates, show me 6% interest rates, and then we can talk. For now, we are not seeing that, and the Fed is seeing that they are destroying financial markets, destroying governments with borrowing costs, etc. So at some point, the feeling is now, okay, market is 20% down. Now it's time for you to chicken out because you are seeing the destruction created. We will see. It's an interesting thing to watch. And they say, of course, let the news, the bad news come in, and then you will retract. And then when it comes to investing today, everyone is watching for the bottom. When will this bottom come? When will be time to buy? Because the best times to buy something is in the crash, in a recession. The best time to buy will likely be when the Fed blinks. But when will they chicken out? We don't know. Let's see a little bit of history. So this is a great chart from the New York Times. So you can see how markets usually anticipate recessions. So here the market crash was anticipating a recession, market crash, then a recession came. Recession is blue, bear markets is orange, yellow, what it is. So again, a little bit early bear market, then a recession came. Here, that was just the flash crash here, nothing spectacular. A little bit not bear market, small recession. Again, stocks started to go down from the exuberance of the dot-com bubble, small recession, then again, in line almost, but stocks usually start crashing earlier. And now we see the market already down, indicating a recession. For now, the market was a good predictor of it, but when it comes to investing, you never know whether the bear market will be a big one or just a small one ending as the recession ends. But we still have to see the recession. So from these charts, historical charts, a long and painful one, there is still plenty of room to go down, and also from what the Fed says. But if we look at history, you can see these happenings and how stocks usually climb a wall of worry, and it is always the best time to buy at the worst possible situations. There are these crises, whatever, but if you buy here, so when it comes to investing, we don't know, we can't predict. It all will depend on the Fed. If the Fed says, okay, we're going to let inflation loose, as they were saying a year ago, then this will quickly revert because businesses will do okay. But if the Fed keeps tightening, we can easily return to previous lows because this is a financially created asset bubble. If they say, okay, let's revert it to half of the past, we still have one or two legs down, as Jeremy Grantham says. So there will always be some worries, always lost decades, can be not cannot be. We have to invest in fundamentals, invest when we like the price, and then simply hope for the best. On my research platform, I just keep buying. I'm leaving 20% of cash for my copper opportunities because I am a specialist in copper, one of the things that I specialize the most. And I said that below 3 we'll start really looking for buys. When copper was above 450, nobody was believing me. Now copper is going down. So time to start looking at those stocks crashing because there is value. The world, I hope, will continue to go forward, do well globally long term, and now you can buy in bad times really things on the cheap. And also here on YouTube we'll keep analyzing companies and also buying for our YouTube portfolio because I think that when it comes to wealth accumulation, there will be recessions, there will be this, there will be the booms, busts. That's normal. That's been there, done that, been there, done that. So we just need to keep accumulating wealth, spending less than what we make, accumulate over time, and then suddenly you turn around after 20 years. Oh, my life is so easy, and all your colleagues that didn't go to the gym, they are in trouble. We just keep investing with recessions, with everything, buy more when it's cheaper, and over the long term, we end up wealthy and better off, well off. And that's the whole point. We cannot predict when something is cheap, buy it. When it's cheaper, buy more. So we'll see how the Fed reacts. I personally feel a little bit that they will chicken out. So we'll have an inflationary situation, a stagflation, where good businesses will do good, cheap businesses will do well. Globally, good businesses will do great over the next 5-10 years. So I am continuing to invest in businesses, looking at margins of safety, bargains out there, and that's what I do here on the channel, on my platform. Check it out, subscribe, and I'll see you in the next video.